Hello traders. So I'm getting quite a few questions on how I define the trend and how I trade the trend. So what I want to do is just run through three basics trend following systems that I follow. There are detailed videos on them and I'll put those links in the description below. But what I want to do is just really reiterate two very important things about a trend. And the first thing is levels. Okay, so I do have videos on levels as well. You'll find that in the description below. But if we just minimize that, so pretty much every tail tells us a story. Okay, what I mean by that is there is a reason why price reversed off that level, and there is another reason why price reversed off this level. And that in itself is something that you need to study. I mean, it's pretty easy when you look at it back here and you see, well, oh, yeah, that's pretty easy. I can see why price did it. But when you move to this side here, when the canvas is white to the right, it's very difficult to ascertain what the level is. That's why I always say look left, draw in your levels. You can see there's a level. The high time frames give you different levels. Okay, so every tail tells a story. There's a reason why price reversed off that level. There's a reason why the seller stepped in there and then the buyer stepped in here. We may not always understand the reason, but there is always a reason. So levels are critical because a trend can continue at a break of a level or it can reverse. Okay, so that is why levels are extremely important. And if I just do that on the top there and we just scroll left, you'll see one solitary tail here where price turned off, and then you can see a little bit of interaction here, a little bit of interaction there. Okay, so levels are very important when we start talking about a trend. So the second element of a trend that is important is the time frame. So what time frame do you use to define a trend? Now, if you look at this is quite simple. We had an uptrend, downtrend, uptrend. Okay, so we had uptrend, consolidation, downtrend, consolidation, uptrend. Now remember, a trend always moves in a direction and then it consolidates. Okay, that's the consolidation there. This one was a triangle consolidation, which is there. Okay, so this is just the way price behaves. It always behaves in this manner. You'll see sometimes the consolidation lasts a lot less. So you can see there's your consolidation at the bottom here. So we had a small trend, consolidation, small trend, consolidation, trend, little consolidation, trend, consolidation, trend, consolidation. Okay, so that is the nature of a trend. Is price is always looking to create new highs and new lows. Okay, and not necessarily all-time highs and all-time lows, but new highs and new lows. That's what price is trying to do. So you need to understand that the trend, you start seeing consolidation, there is a high probability of a continuation, and there's also a high probability of a reversal. So regardless of which way price breaks up or down, that will give you the indication of where we're going. Okay, now inside, let's look at this area here. So inside this consolidation here, the time frame will define for you what you need to do. So I'll go back. So I've gone down to the 5 minutes here. I think what we need to do is just pick it up on the high time frame. Okay, so I'm going to go to the 30-minute, and you can see how we have multiple trends on the 30-minute. Now, if I break this down, and let's just put a line in there. If I take us down to the 5-minute now, and we go find our line, there it is there, you can see that I had an uptrend, Okay, I had a 1 bar consolidation on the 5 minute before having a downtrend. So if you are trading the 5 minute, there's an uptrend, there's a downtrend, there's multiple trend changes in a day. So, and that's what you need to trade. You need to trade bottom of a range. It's hit a level. I suspect we're going to bounce. Okay, we're bouncing. I'm long for this. Okay, we've hit a level, and I'm just saying we've hit a level. But if we look back on the higher time frames, you will see that that was a level. There's tails. I keep looking back. There's tails. There's tails. I look at the bottom. There's tails. There's tails. Okay, so every tail tells a story. So levels are important and time frame is important. Whatever you feel comfortable trading is what you need to trade. So for me, on different instruments, I have a different view of trend. For the Dow, 4 hour gives me a trend. Okay, and for something like the South African Aussie, it's either a 30-minute or a 1 hour that gives me my trend. And the only reason for that is on the South African market, we have much more volatile moves in the day. So, one day can give us 1,000 points. You're trading $1 per point on that. You're getting $1,000 in a day. So that kind of, for me, depending on the instrument I'm trading, it would be different time frames that I would look at. Some of the stocks that I trade, I look at daily and weekly trends rather than lower time frame trends. Okay, so that is the basis of how I look at trends. So time frame is important and levels are important. Levels are important because price will potentially reverse or break through a level. Okay, so there is a video that I did on reversal patterns. I'll link that in the description as well, because that's something else that you actually need to identify as well. Right, so next, what I want to do is show you three very, let's not call them simple, but three trend following systems that I utilize. Two of them are pretty basic and pretty easy to understand, and the third one, being Ichimoku, is a little bit more complex to understand. So what I'm going to do is I'm going to start off with the moving average. So you can see I've got different templates that I've defined for my strategies. Okay, so let's just delete that line and delete that line. Right, so the first one is pretty much what you see on my videos every day, and this is a Bollinger Band and a moving average strategy. It's pretty much just a moving average strategy, more than anything else. So I have purple line, which is a 200 moving average, and I'm not going to talk too much about it, but it's a 200 EMA, and you can see why I have it on my charts. Okay, price interacts with it. The green is the Bollinger Band, so obviously this middle Bollinger is the 20 moving average. This red is a 40 moving average, 40 EMA, and then I have a 5 moving average being the blue. So the strategy is pretty simple. What I'm looking for is a crossover of the blue and green. Okay, when I get the crossover and price stays above the 20 moving average, like here, that's an indication to be long, and there's no reason yet to get out of this. If price had broken through here and closed convincingly below this bar, that would have indicated a close and an open below the 20 moving average and a lower low. That would have given me an indication that this would be moving down and you'd be looking for shorts. Okay, but this consolidation, gap down, consolidate, and we move, continued moving. So this trend is still very much intact to the upside. If I look to the left here, you can see how we've got a double bottom, broke through the 20, and we've stayed above the 20 until this consolidation phase, and then we broke through, creating a new low. We took out that low there, took it out, came back to test the 20. Okay, that is my move to the downside. So there is a bit of science into seeing how the breakouts happen and the retest. So you always want to see a retest of the consolidation break. So below this line was a break, retest of the consolidation break was there. So that is short, and you stay on this trade, trading the 4 hour now, until you get a close above the 20, which happened here. Now's your first warning that something's about to happen. There's normally a second push. There's a second push down, and you get out. And now what you can expect is consolidation. So you know that a trends, consolidates, Okay, so that's a pretty simple moving average strategy. And regardless of what time frame you want to trade, if you look at the 5 minute, if I go to Friday, I think Friday was a great example. So you can see we opened gap up above the 20, consolidated, broke the upside, so we've got a mini uptrend here, and then we broke below the 20, and then there was your retest. Okay, so that gives you an indication, this is going down. So now we stay with this trend until we get a 5 minutes close above the 20 moving average and a takeout of the previous fractional high. So you can see that was pretty close on this bar, but it reversed off. And it's also important to wait for the bars to close before you make decisions. And you can see how this trend moved to the downside, and then we started consolidating, and it was quite a long consolidation phase, and then we broke to the upside, and there was the upside, and now we've consolidated again. Okay, so that is the very simple moving average strategy that I've used, and it's pretty much just using the 20 and the 5 to define where you are. You can use the 40 as well. I use the 40 just really as a confirmation for me. Okay, now you can use any number of moving averages that you feel is necessary to your trading style, and you'll find that different time frames or different moving averages will work differently for you on different time frames. So you just need to work through it on whatever instrument you're trading, and then stick with one and don't keep changing it. Stick with it, learn it, understand it, trade it. Okay, and that is the best way how you master that one position. Okay, so the next thing that I often use as well is the Bill Williams strategy. Now, again, I've got a few extra things on this chart, and I'm just going to get rid of them for now. So the first one is a Bollinger. Let's get rid of the Bollinger. And I've also got the stochastics here, but I think for this purpose, let's just get rid of those. And I also have the MACD. I'm going to delete the MACD. Right, so for the Bill Williams strategy, you need the Bill Williams alligator, which is this red, blue, and green line. And you need the awesome oscillator, which is down here. Now, I have 3 separate videos on this, and I'll link all of those videos in the bottom. So the concept is the same, though. You above the Bill Williams alligator and they're pointing up, you're long. And prices below the alligator and pointing down, you're short. Okay, and your awesome oscillator will give you an indication when the momentum is changing. You can see move to the downside, then you get 3 green candles here moving up. Okay, there's an indication that something's about to happen, and it did consolidate and then did nothing, and then all of a sudden we start accelerating to the upside. So this is long. Okay, and again, regardless of what time frame you're trading, this was the hour, it works on pretty much all time frames. Okay, and come back to the 4 hour, and you'll see below the alligator, pointing all the way down, consolidate, above the alligator, we're long. Okay, so in these consolidation phases, obviously the lower time frames is the one that you are looking for. When you are on the higher time frames and you're moving, you're trending, then you just stick with that trend and you go with it. Okay, so again, time frames are important, and you can see sometimes it's messy and you've got no real clear direction of where it's going. Okay, so that is the second one that I utilize quite often, and the third one is probably the most it's the most complex one, but it is also the one that you can pretty much almost bet. I wanted to say bet the farm on, but that's probably the wrong analogy. But you know, it's one that you can trust the most. Now, I've also got a few. I just overlaid the moving average here. I was doing a bit of back testing. So the Ichimoku is very simple. Okay, so there is a number theory component to this, and there is a wave theory, which is similar to Elliot's wave. which is also very important and probably more important than the concept that I'm going to show you now. But the reality is, for keeping things simple, if you have a crossover of these two, of Ichimoku's Kijinsen and Tikinsen, which essentially are moving averages as well, okay, I have a crossover and I stay below, I trend down. If I'm below the cloud, it's a defined downtrend. If I'm above the cloud, it's a defined uptrend. And if I'm above Kijinsen and Tikinsen, we're in an uptrend. Okay, it's simple as that, right? So, and again, this was designed for the daily time frames. And you can see from the daily time frame here, we are in the cloud, we are consolidating, we are still consolidating. If I look further back to the left, you can see how there was no reason ever to get out of this long from down here if you're trading the daily time frame. And the number theory is really about the key numbers, which it's 7, 26, 42 are the three that I utilize. And you can see how things change at different, there's 40, there's 41, there's 42. You can see from the breakout here, 42 bars consolidate, and probably consolidated 9 bars from there, 8, 9th bar breakout. So moving to the upside. So, I'm not going to talk about that component yet, and I don't have a video on the number theory and the wave theory. I will get to that soon. But for this, designed for the higher time frames, it works pretty much on all time frames. So you can see on the hour, we're staying above the cloud. We did get into the cloud here. And you can see when we have red above blue, so Kijinsen above Tikinsen, that is always an indication that we're going to move to the downside, but we would need to break below the level. So there's a level there, which we didn't break below. We tested the tail. But we need to have a close below that, and then a close below the cloud for this downtrend to continue. And we didn't get it. So we got a bit of consolidation. Then we got a crossover, you can see here, and then a retest of the cloud, and then we accelerated away. So the simplicity of this is when we are in the cloud, and I'm going to go back to the 4 hour for this. So, often when we below the cloud and we keep coming up to test the cloud like this, we're consolidating. When Kijinsen and Tikinsen are running flat, we're consolidating. When the cloud is running flat, we're consolidating. And then often we break through the cloud, and all of a sudden, everything points to the upside, and we start accelerating away. See how the cloud points to the upside, Tikinsen, Kijinsen point to the upside, indicating strong uptrend. Okay, and lastly, if we take this strategy on the 5 minute, and again, I'm just going to stick to Friday here, you can see at the early hours of the morning, the open, we're kind of going flat, and then you can see how price fails to break through Kijinsen here, the red line, and you would take a trade on the break above here. That would be long, and then you can see how price action is starting to change, and you could actually wait for a break below Tikinsen to get out, or alternatively understand that that was a major level, which is probably a clever way to do it. And you can see there's a major level there with a gap close, and there was an inside tail there. Okay, so that's why levels are pretty important. And you can see how, get back there, you can see how we hit that level and we started moving to the downside. And now we only got the crossover here. So the thing with Ichimoku is, whereas you could have taken a trade higher up, the confirmation only comes 21 points after it actually happened. So it's a safer way, it's a kind of a safer bet. So this bar here, you've got a reversal bar, so you've got off a level. So the level is Kijinsen. You can see how we rallied up to it, reversed off it, and that was your signal bar with a crossover, indicating that it's time to look for shorts. And here we go. Retest of the cloud was another entry short, and you can trade this thing short off every reversal off Kijinsen or Tikinsen. And that pretty much sums up the Ichimoku theory. And you can see how here we consolidated, and you can see how Ichimoku is now intertwined, and we get a crossover here, we get a negative crossover here, and then we eventually get another crossover and a break of the cloud at the same time, which is always bullish, and we move to the upside. Okay, so that's kind of how I follow the trend. Um, Now, as I say, it depends on the conditions of the market of which system I'm going to be following. For example, the South African Aussie, I will use Ichimoku on the 12-minute and the 30-minute, which to me is just the greatest view of how it works. But often I'll just use a simple moving average or the Bill Williams because it's simple and keeps you on the right side of the trend. Okay, so I will link all those detailed videos in the description below. Otherwise, this video would be extremely long. And I hope that helps you. And remember, staying with the trend keeps you in profit a hell of a lot longer than trying to counter trend. And a lot of your so-called experts that you pay money to, and I've paid money to a lot of them, and I've been burnt with a lot of them, and it just forced me to focus on understanding, what's going on with price. And the level is the most critical element of it. And the second element is the time frame you're going to trade, because one person could call an uptrend and he's trading on a weekly, and another person will call a downtrend and he's trading on a 1 hour, and you just start getting confused. So the best bit of advice I can give you is stick to a time frame that you're comfortable with. Trade that time frame only. If you're defining a trend on an hour, then that is what the trend is. So if you're going to get down to a 5-minute, then you're going to trade only with that trend. You're not looking for counter trend trades. Okay? Even if it means that you're going to miss out on a 300-point scalp, it doesn't matter. As soon as it hits a level, you're in for the long, and you can now confidently leave that long, get on with life, because you are in with the trend. And the chances of you, the probability rather of that trend breaking in the blink of an eye is far lower than you being stopped out because you're trying to counter trend trade. Okay, guys, I hope that helps. Any questions, fire away in the comments below. I'll do my best to answer them. And give us a thumbs up or a thumbs down, and drop us a comment. Love to engage with you guys. Anyway, enjoy the day. Catch you guys later. Cheers, man.